Hi everybody, welcome to this video. My name is Chris Harris. I'm a certified financial planner, and today we're going to be talking about why asset allocation matters when it comes to your portfolio. And so this is a topic that I think gets really confusing. There's a lot of financial jargon, and so we're going to hopefully make that simple and easy for you to understand. But as a disclaimer, this video is for informational and educational purposes only and should not be considered investment, tax, or legal advice. Okay, so let's dive into this. Talking about asset allocation. So the first thing that we want to talk about when it comes to asset allocation is we want to understand risk, okay? Really our risk tolerance. And you're probably thinking like, okay, I've heard that word before, but what the heck is it? So when it comes to our risk tolerance, this is really our emotional or behavioral side of what we are able to tolerate when it comes to the risk that we see in the market, right? And so we see this as an emotional aspect of investing, okay? How we uncover or investigate this risk tolerance is by doing what's called a questionnaire. Now, you may have seen people, whether it's friends, families, or whatever, family members, and they go pick a slew of stocks or whatever it is, and they're like, oh, this is, I heard this one was good based off of so-and-so, and they just, they're not creating any sense of risk tolerance, right? They haven't understood what their risk tolerance is. And the reason why this is so important is because you have a few different biases or things that kind of happen emotionally or behaviorally when the market doesn't react how you think it should react, right? Or what you were anticipating. So we have FOMO. So like for instance, if somebody bought a stock at X price and it rose and they gained X amount percent, and you're like, oh my gosh, I totally missed out on that. I'm gonna go buy it. Even though it's at all-time highs, I'm gonna buy it based off of just having that fear of missing out on an appreciating asset. Okay. The opposite of that is panic selling. So we see this one a lot, right? So when the market starts to erode or things get a little scary, then it's like, I need to sell. I need to move out to cash, right? And we saw this a lot during like the pandemic, or we saw this during the tariffs, or even the Iran war that's been going on. Different situations have caused investors to feel that emotional pain because they see what's happening in their portfolios. Okay, so that's another one. And we have recency bias. So recency biases are like, if the market's going up, oh, it's always going to go up. Or if the market's going down, it's going to continue to go down, right? So we see kind of patterns in there like, oh, okay, like that's going to either give me more anxiety or feel like I'm invincible, right? I'm the best investor in the world because my portfolio is going to keep going up. And so what we try to do with these questionnaires is we try to uncover these emotional behaviors, okay? And that's why it's so important, because we ask questions like, how would you feel if the market dropped 30%? Would that give you a lot of anxiety? Would you be fine? Like, would you stay awake at night? Would you, how would you react? Would you want to sell out of everything? So this is why it's so important to understand our risk tolerance before we start building our portfolio. Okay? So let's kind of dive into just the basics of our portfolio. And this is why we have to understand our risk because we have our equity portion and our fixed income portion. Okay, fixed income. Okay, so equity, you can think of this like stocks in companies, right? So you have ownership in the company, and we can tend to view this as very volatile. So a lot of up and down movements, okay? Fixed income, so you can think of that as like more steady. There's still some bumps in it, but this is debt. So you can think of, treasuries, corporate bonds, government bonds, a lot of different fixed income products. And so there are two different things that not all of the time, but kind of work against each other in a sense, okay? So this is where we look at equities as generally more risk, okay? And fixed income as generally less risk, okay? Now there's still some risk. There's just being invested is inherently risky, but there's, again, generally less risk, especially if you have, treasuries or, things like that where it's backed by the US government. Those tend to have less risk associated than if you were to say being invested into like a company. Okay. So that's kind of our base structure of when we start to do asset allocation. And then we can see that we have over here, this is, you've probably seen this if you have a 401k or some, you have a portfolio of your own, you've probably seen the same kind of situation. Maybe you haven't really understood what it means, but this is allocated to different positions in equities, and then it has different positions in fixed income. Okay, so equities over here and fixed income down here, okay? Now, within these, we have sleeves of different types of investments, okay? Large companies, small companies, international, right? So kind of have these sleeves of different types or sectors or, different investments. So kind of create this diversified portfolio or structure of equities. And then the same with the fixed income. So we're going to have a diversified sleeves of different investments, okay, to make up our fixed income. So that is a basic portfolio, and this could be 60% in equities and 40% in fixed income, or 80% in equities, or 30 or 20% in fixed income. And that is going to, when we have these two, let's see if I can kind of draw this here. Kind of makes sense here, so I'll erase this. So if we have our equities that kind of go like this, we see a lot of volatility, and then our fixed incomes kind of go like this, right? Not as much volatility. There's still some, and there still can be volatility, but just, again, we can kind of smooth out by combining the equities and the fixed income to become a little bit smoother ride. Does that make sense? So hopefully you can kind of understand the picture of why you would want to do, have some sort of asset allocation based off of your risk. Okay, so this slide I think illustrates it a little bit cleaner, a little bit more simple. But as an example, again, this is not investment advice, so this is just as an example. Let's say during your working years, you were, so this is, say you were age 30 to age, 50, you felt based off of your risk tolerance that you could take more risks. You still wanted growth in your portfolio, but you still wanted a little bit of, I guess less volatility within the portfolio when markets were really shaky and things like that. So you decided that you wanted an 80-20 portfolio. So this would be equity and this would be fixed income. So 80% of your portfolio is in equity and 20% is in fixed income. So this is what we would consider a growth portfolio. Okay. And then let's say when you're 51 and you're like, I'm starting to get a little nervous. I want to retire in the next, little bit. So you're starting to get, there's some shaky things going on in the market and the economy. You're really worried. You're like, I don't have that much longer to work. Maybe I want to start, winding down at 60 or 65 or whatever that looks like. You're going to reallocate your portfolio maybe to being more conservative, right? So now we get into more of a conservative. It's more balanced. Now we have our equity at 60% and our fixed income at 40%, okay? So we still have a growth component. We're still gonna see some volatility in the portfolio, but we've taken or reduced some risk, right? From this portfolio to this portfolio, okay? And then maybe in retirement, you're like, okay, I'm starting to hang things up, or maybe I didn't retire until 65, but maybe I'm like, I really want to, really be smart, and I want to have my nest egg, and I don't really want it to do a ton of moving, but I'm okay with taking a little bit of risk at this point just for growth in the portfolio. So maybe you move it to a 40-60. So now our equity position is a lot lower than our fixed income. And this can be, maybe we want to tilt the portfolio to be more cash flow, right? So we want more instruments, like interest instruments in there. So it's shelling off more interest. It's fixed income. So maybe bonds or, things of that nature where it's going to give us a little bit more income in retirement, but we're still going to have maybe a little bit of growth. And again, these numbers, these are just for example. So you can make the argument for a lot of different things, right? You can be, oh, that's too aggressive in retirement, or, not aggressive enough, or whatever, right? The point that I'm trying to make is that this asset allocation does and can change throughout your, throughout your career and even retirement, okay? This is what we're doing. We're reducing, so we are reducing risk. So we are reducing risk over time, right? So if you think about it, we try to accumulate, have more growth, take more risk the younger that we are, because we have a thing on our side that's really crucial, and it is time. We have time on our side to go through the ebbs and flows of the market, corrections, recessions, things like that, to continue to build our portfolio. Then as we get closer to our retirement years, then we've accumulated what we can. So now we want to secure, most of that portfolio and either use that as cash bearing, or maybe if we're going to give it an inheritance, we want to have it at, a nice stable portfolio so that it can be inherited, right? There's a lot of different situations where that would make sense in terms of keeping that nest egg more, or I guess taking less risk during those later years. Okay. So this chart here illustrates the reason why we do want to asset allocate, right? Because we have this max drawdown. So these little dots here are the max drawdowns in any given year. Okay. So for instance, this year, 2026, we've had a max drawdown of -9. The market is now -4. This is as of April 1st. So this can obviously change depending on when you're watching the video, but just for illustration purposes, I think this makes a lot of sense. So last year we were down -19%, but we ended the year at a +16% and this is the S&P 500. Okay, but you can see that throughout the years, we have a lot of volatility, right? A lot of drawdowns, meaning the market is going to really, that's kind of a normal part of investing, is to see these drawdowns. And so it's important, again, to understand your risk, because if you really struggle with these drawdowns, and you're like, even some of these, returns, when you're like, oh man, these negatives, they do creep in there. And you can lose money, right, in the market if you pull out when the market's down. That's when you want to be very cognizant of how you're allocated, how your portfolio is allocated, right? So that's the importance there. So how does this tie into a real life scenario. Okay, so this is Crispy Bacon and Marshmallow. I did another video with them on Social Security, but we put their facts in, all of their information within the planner. And now we can see, and again, this is just adding growth at different rates, okay, based off of our asset allocation. So if we have a higher or a more portfolio that's geared more towards equities, then we are expecting a higher return. That's really where it comes. We're a higher growth rate, right? Doesn't mean that always ends that way, but that's what we're trying to accomplish when we're in a full 100% equity position. Now, if we have a 100% fixed income position, then we are saying, well, generally, we're not as expecting a bigger portfolio increase compared to the equities, right? Again, there's a lot of variables with these. This is just very simple and basic in terms of how it's the thought process behind it. So if we look at the growth rates here, so we're saying Chris P and Marcia. So they decided that they were going to just keep their portfolios invested into a 4%, just level investment. Okay, maybe it was like a fixed income, or it was maybe a CD rate that they got at which it was a 4% CD. Let's just say. Okay, over the course of their career, and they decided not to make any changes to their allocation and wanted to be very, very conservative. Well, as you can see that over the course of their life, they actually lost $912,000, almost $1 million, and lost 8 years of funding for their retirement. Before, their base scenario, what we started out was around 6%. Maybe it was like 5 point, almost 6%. Well, what happens when we grow the portfolio at 7%? So maybe they're now saying, hey, you know what? We're going to grow it. We're going to put a little bit more equities, see if we can average a little bit more throughout our working years and have that compound. And as you can see now, that green is the growth on the portfolio based off of our initial plan here. So what this is showing, as you can see over here, the value gained is $5 million, right? And we've funded now 7+ years. So that's a huge difference in terms of retirement, right? So going from an asset allocation where, and again, this is throughout their working years, and retirement years. So they were growing that rate well before they retired. And then they grow that all the way through retirement. That's what this is saying. But that's the power of the asset allocation, right? Is because if we're not allocated appropriately, because again, we want to weigh the risk, but then we also want to weigh, can we retire based off of that risk tolerance? You're like, well, I can't take any risk, and I'm good with my 4% CD for the rest of my life. That's fine until you have to retire and you don't have enough assets because you haven't accumulated enough assets throughout your working years because your growth rate was too little, right? We were too conservative for too long. And so that's really where we want to be aware of both our risk tolerance, but then we also want to be aware of, can we retire, right? And if maybe we do need to take a little bit more risk if we want to make retirement based off of our goals. Okay, so there's a lot that goes into this. I tried to make it simple. Hopefully this was somewhat simple for you to understand, but it's really why asset allocation matters. And, again, this is going to be a very individual thing for you. So please, don't take this as a specific advice for you to change or do your own portfolio, as it is a very individualized kind of situation. Okay. All right. Thanks for watching. And we'll catch you on the next video.